Good afternoon, welcome to Market Wrap number 124. Stuart Williamson here at the helm. This week we have a smorgasbord of economic news to digest as we try and help our clients, new people who are interested, make buying decisions in the UK property market. That's why we produce these market wraps, to put information out there that will help clients, help you make buying decisions and show that we can do a good job. Because at the end of the day, that's how we earn our money, by helping people. Okay, Rishi Sunak, the first Hindu UK Prime Minister, took office on Wednesday, prompting generally positive reviews for both the economy and sterling, has had a knock-on effect for the UK residential property market. After Mr Sunak's appointment, Dean Turner, Chief Eurozone and UK economist at UBS Wealth Management, said the market reaction to Mr Johnson's withdrawal and Sunak's win has seen gilt yields fall sharply across the curve, while the pound has been steady against major currencies. Sunak's victory will not call a halt to the political volatility in the UK, but the temperature should cool. Yeah, I mean, we have seen a lot more stability, in Prime Minister's question time yesterday. It was a lot more positive it's been for a while. That will have a knock-on effect, as I said, to sterling, because it'll therefore help reduce inflation. I mean, sterling has risen to levels last seen before Truss's mini budget. It jumped 2 cents against the US dollar to a high of 114, Imagine, I never thought I'd say that. On Tuesday afternoon, a notable gain of 2%. And as of Thursday, it's risen to 116. That means the pound is worth more than any point since the 15th of September this year. It's not just the pound's strength though, the pound has benefited from a slump in the dollar following the sharpest slowdown in US house price growth on record. US house prices, which could potentially augur badly for here in the UK, what they say, the US sneezes, we catch a cold. US house prices grew 13% in the 12 months to August, down from 15.6% in July. According to the S&P index, the biggest drop in the index's history. The benefit of the rising pound is that it makes imports less expensive and will therefore curb inflation, which is where interest rates are all about. However, from a negative perspective, prior to Mr Sunak's appointment, Moody's, the rating agency, cut the UK's outlook to negative from stable, citing heightened unpredictability in policy making. Amid weaker growth prospects, higher inflation and risks to debt affordability from likely higher borrowing, the agency said it would keep its credit rating of AA3. However, the country's long-standing institutional framework does remain strong and will continue to support the UK's ability to respond to shocks as seen during the pandemic. Furthermore, the structure of the UK government's debt, which is sterling based, and we live in sterling, with a long-term average maturity of 15 years, as well as a deep domestic investor base, adds a degree of resilience to the credit profile in the face of shocks. So that's negative pressure on sterling. That'll push it down. I mean, the point about borrowing in sterling and living in sterling is not like Argentina that borrows in US dollars and, has to pay it back even though they're not earning that. Okay, more positively, interest rates may peak at 5% in this cycle. Why do I say that? Because a speech given by the Bank of England Deputy Governor Ben Broadbent earlier this week arguably holds greater immediate consequences than what Moody's have done. You can have a look at the Financial Times, they've got a great write-up on it in full. Mr Broadbent basically shared internal Bank of England modelling suggesting that the base rate would peak at a lower level than 5.25% currently priced in the financial markets. The modelling sought to weigh how much interest rates would need to rise to offset the inflationary aspects of sterling's depreciation and the energy package, not the tax cuts, not including the tax bucks from the mini budget, so they seem to have dismissed those that will be reversed. The calculations suggest that additional increases of just 0.75% could be required on top of previous forecasts rather than 2.25% suggested by the yield curve below. So have a look at that yield curve. However, he did say, with a name like Broadbent, I always want to put a Yorkshire accent on, the modelling should be taken with a healthy dose of salt, Mr Broadbent said. Nevertheless, investors pared back their rate rise expectations by 0.25% following the speech, with financial markets now pricing in a base rate of 5% next June. Okay, that's great, because that's indicating that could be the top of it. Based on this information, that's all it is. I'm not suggesting that's what it will be. Based on that, it could be the top of the rises. So let's look at the mortgage market, what's happening there. On the back of this stability news in the UK, the 5-year fixed rate from a number of lenders, I think it was 4 lenders, actually fell yesterday by 0.2% to 5.2%, which is fantastic. Why did they do this? Well, basically with mortgages, you have the base rate from the Bank of England, and then you have a risk factor that the bank adds on to it. And in times of instability, this is greater. Hence, with them feeling a bit more comfortable, they reduced it, which is excellent. Meanwhile, quite a few banks have withdrawn the higher loan-to-value range loans we've got out there. Moneyfacts data covered by this morning's FT again says that the number of mortgages at 95% loan-to-value dropped from 347 at the start of the year to 135 as of last Friday. It's just taking the risk out of the market, as simple as that. Now, at APW, we often focus on ties, okay, which is transport, infrastructure and employment, when looking at where might be a good place to buy. And this is crucial in this tough market. Part of the mix that should also be considered, perhaps, is the quality of schooling in the locations you're considering. Now, Knight Frank reports that the deadline for secondary school applications is the end of this month, and they have pinpointed housing markets across England, only England I'm afraid, they haven't got data for Scotland or Wales, Northern Ireland, anywhere else, Madagascar, Timbuktu. They just looked at the best outstanding rated secondary schools out there. They analysed more than 500 outstanding schools and compared the average sale price for a house within 2 kilometres of the respective postcode district to the local authority average. In London, they reduced it down to 1 kilometre to reflect the greater density of housing and population. Now, outside of the capital, I should be asking you to do a competition on this. Where do you think dominated? Well, outside of the capital, Yorkshire and the Humber dominate. In the capital, outer London offers the best relative affordability with access to top-rated secondary schools. The average sale price in SM4 in London, which is the London Borough of Merton, which includes areas such as Wimbledon and Mitcham, was 27% below the local authority average in the 12 months to April 2022. We're putting the data up here for you to have a look at. You might want to screenshot it because it's interesting to see what schools and in what areas are most successful and affordable. Okay, according to Knight Frank's latest sentiment survey, proximity to a highly rated school was as or more important to 72% of the buyers than it was a year ago. It's part of, I think, this whole concept of post-COVID being more user-friendly, care-friendly, looking after your family, that sort of thing. You don't want your kids having to schlep miles to a good school, but you want to have a good education. So that's really important, I think. And that is the way a lot of our buyers are looking at, more of a head decision previously, now heart is coming more into it. Okay, so basically these are the charts to show you where the best locations are. We had a look at Birmingham because Birmingham is one of the areas that we believe is a great investment location with HS2, with levelling up. I believe Goldman Sachs just took out another 120,000 square foot lease on a building there. So if we look at Birmingham, for example, we have this 3-bed freehold house for sale in Billesley near Edgbaston at £190,000 with a rental yield of 5.5% currently. It's a great buy, good value, good rental yield, and it's in the catchment area of the outstanding, according to Ofsted, schools of Swanhurst, King Edward V, Camp, Dame Ellen Pinsent and Bishop Challoner schools. Great location, good potential growth, freehold, good schools. Now very quickly I just want to cover house building targets. The Telegraph reported on Wednesday that the government intends to push on with scrapping the long-held target of reaching 300,000 net additional homes each year. It's one of the several planning reforms that survive Chancellor Jeremy Hunt's overhaul of Liz Truss's policy framework. One of the very few, apparently. The Office of Budget Responsibility, OBR, will publish forecasts for housing delivery alongside the fiscal event, as they call it, or the budget now as it is, in November. The Home Builders Federation has written to the spending watchdog, and the Daily Telegraph has seen a copy of this letter, suggesting the government's policy proposal would result in an annual housing completions drop-off as low as 140,000. So down from the current 240 that were built last year, 140. Now, local councils, which are responsible for allocating land for development, will significantly reduce planning permissions when pressure from Whitehall is removed, the group basically stated. Now, what's the rationale for this? The government says it no longer needs a Stalin-esque target like this. I mean, if this isn't woke or whatever the word is, gone mad, it's a target because it's required for us to survive in the UK. The HBF says it will lose the economy 17 billion a year in earnings and the government 1.2 billion in taxes, and will only add to the shortage of housing in the UK, so that we're all aware of. And basically just does not seem a very clever approach. It seems to fly in the face of all this talk of building more affordable homes, sustainable homes, solving the energy crisis. And it seems complete madness to me. I mean, I may be missing something, and it may be a real strong story, and do correct me. Anyway, there we go. That is the market wrap for this week. Thank you very much for listening. Do hope you enjoyed it. Do press like, subscribe. If you want to hear more information about what we do and how we do it, please do fill in the form below. Thank you very much, and let's hope that we speak next. We haven't got another Prime Minister. Cheerio.